So we get to presentation and analysis. So there's all the usual disclosures that you have to have, and I think you can probably read those over. The best thing to do on these sometimes is to look at the financials of an actual company and to see exactly what they tell. They may have very minimal or summary information on the balance sheet itself, but then there'll be a lot of schedules in the notes to the financial statements that are required with all of the various schedules on it. So you have to report your operational assets separate from your idle assets, because to be called property, plant, and equipment, it has to be used in the operations. If you've got assets you're not using, that's a separate item and a separate schedule. All of the depreciation methods, and the different classes, and so basically fairly straightforward stuff. As far as analysis goes, they talk about your asset turnover and your return on assets. And these come in handy for just seeing the reasonableness of your financial statements and comparing them over time with themselves and then comparing them against industry averages. So you take your net sales, average total assets, and it's just telling you, well, how much sales is, how many are provided by each dollar of our assets, okay? And then you have your return on assets, that's your net income, divided by your average total assets. Those are numbers that you can take a look at. You have to figure, well, do we want a bigger number or a smaller number? Is that, which is better? And just play with them a little bit until you get used to them. There's a lot of room for messing with your depreciation in order to what they call dress up earnings. And I mean, it's awful. I mean, this goes back to the 80s, but General Motors, it's such a good example. They wanted to dress up earnings. So if you have a boss that comes to you and say, yeah, I think we should dress up the earnings a little bit, no, you don't want to do that. Not a good idea. So in the 80s, GM, they liberalized their accounting policies, and they posted record earnings. Well, so what this amounted to is that 1.8 billion of their 4.9 billion profit came from the change in the depreciation period of planned assets of 35 to 45 years. So in other words, they're dividing by a bigger number, smaller depreciation expense each year. Oh, look what happens to our net income. Kaboom. Okay, change in accounting for pensions. That doesn't have anything to do with this chapter, but it's part of what they did. They changed their inventory valuations policies, and their change in the assumptions about residual value of leased out cars. So that's the salvage value. Oh, well, they've got a lot more salvage value. That'll all be good. And so these were all the things they did to dress up their earnings. Needless to say, the SEC did not find it amusing, and it did not end well. Okay, so a lot of times what I would like you to think about doing, and it's hard to imagine now, but someday you actually may invest in various stocks and have to see which ones might be good and which ones might not be so good. And a lot of this is you're analyzing financial statements for self-defense. Even if you're going to go work for a company, you want to work for a company that has all kinds of questionable stuff going on. Using just some industry norms and comparing a company against them. What are our depreciation policies compared with what are the usual ones? And are they really, do the asset lives make sense? Things like that. Okay, so the other thing that I want to take a quick look at, and we don't really cover this, but you should be aware of it, is for tax purposes, what is used is the Modified Accelerated Cost Recovery System, MACRS. You should be aware that that exists. And generally, if you run into it, they don't use any estimated useful lives or salvage values, but each type of asset is placed in a category. It's either 3, 5, 7, 10, or 15, or 20 years. And depending on the category, the government assigns, or the IRS assigns a rate that is used for the depreciation for that year. So this is tax depreciation. You'll run into that in your taxation courses. But as I say, you just need to be aware that, yes, this exists and this is what has to be used for taxes. Okay, Goals of taxes are very different from the goals of accountants. We are trying to allocate the cost of an asset over its, the time it's providing service to the company. And tax policies are totally different. They might want to stimulate the economy or dampen the economy or generate revenue. They've got a whole bunch of different goals. So after 9/11, there was a sort of a recession going on anyway. They allowed a 30% depreciation bonus for the first year for year one of a new asset, in order to stimulate the economy. That's got nothing to do with allocating the cost properly over the useful life. Okay, so just be aware of that. And that kind of wraps up chapter 11.